Welcome back to the channel. In part 1, we explored the timeless principles of the Boglehead's Guide to Investing. In part 2, we showed you how to build a simple, powerful, long-term investment portfolio using index funds. Today in part 3, we're diving into something that separates successful investors from those who lose money, give up early, or never build real wealth. Cross-mark mistakes. Beginner investors often fall into traps that cost them thousands, sometimes even their future.
The good news.
Boglehead investing is specifically designed to help you avoid every one of these mistakes. So let's walk through the 7 most common and dangerous investing mistakes, and how you can avoid them. Warning: mistake number 1. Trying to time the market. One of the most tempting mistakes beginners make is trying to predict the market. They ask, should I wait for a dip?
Is a crash coming?
Is this the best time to buy? The Boglehead philosophy is simple. Time in the market beats timing the market. Even professionals can't predict when markets will rise or fall. And missing just a few of the best days can drastically reduce your returns. White heavy check mark what to do instead. Automate your investments. Invest on a consistent schedule. Monthly, bi-weekly, etc. Stick to your plan, especially when the news is scary. Warning: mistake number 2. Chasing hot stocks or trends. Crypto, meme stocks, IPOs, AI startups. Every year, there's a new trend that looks like a fast track to riches. The problem is, what goes up fast usually comes down just as fast. Bogleheads avoid hype by focusing on the total market. Instead of trying to pick winners, they own everything through index funds. White heavy check mark what to do instead. Avoid stock picking. Don't follow Reddit or TikTok tips. Stick to a diversified index-based strategy. Warning: mistake number 3. Paying high fees. Most people have no idea how much they're paying in investment fees. A 1% fee might sound small, but over 30 years, it can eat up over 25% of your portfolio. The Boglehead approach is to minimize fees at all costs. White heavy check mark what to do instead. Choose low-cost index funds like Vanguard, Schwab, or Fidelity. Avoid actively managed mutual funds and financial advisors who charge commissions. Look for expense ratios below 0.1% whenever possible. Warning: mistake number 4. Not having a written plan. Most beginners invest without a clear plan. They open an account, buy random funds, and hope for the best. But hope is not a strategy. Bogleheads follow something called an Investment Policy Statement, IPS. A simple document outlining your goals, your asset allocation, your contribution plan, your rules for rebalancing, what you'll do during market drops. White heavy check mark what to do instead. Write down your long-term goals and strategy. Commit to sticking with it, no matter what the headlines say. Use your IPS to stay calm during market chaos. Warning: mistake number 5. Ignoring tax-advantaged accounts. Many investors start with a regular brokerage account and miss the opportunity to invest tax-free or tax-deferred. Bogleheads use every available tax shelter before investing in taxable accounts. White heavy check mark what to do instead. Max out your 401k, especially if your employer offers a match. Open a Roth IRA or traditional IRA. Use an HSA if you have a high-deductible health plan. Only then consider taxable accounts for extra investing. Taxes may not seem urgent now, but over decades, they can take a massive bite out of your returns. Warning: mistake number 6. Letting emotions drive decisions. Fear and greed are powerful forces. Many investors panic and sell when markets drop, or go all in when things are booming. This emotional cycle destroys wealth.
The Boglehead solution?
Ignore the noise. Trust the process. Stay the course. White heavy check mark what to do instead. Don't check your portfolio every day. Turn off the financial news. Focus on decades, not days. Remember, the market rewards patience, not perfection. Warning, mistake number 7. Overcomplicating everything. Many beginners think they need to buy 10 plus funds, time the market, follow news, charts, and expert opinions, reallocate constantly. But complexity doesn't equal success. Bogleheads embrace simplicity. Most use just 3 funds. They rarely make changes, and they outperform most active investors. White heavy check mark what to do instead. Stick with the 3-fund portfolio. Rebalance once a year. Spend your time living, not obsessing over your investments. Pushpin summary. Avoid these 7 investing mistakes. Let's recap the 7 common beginner mistakes and how the Boglehead strategy protects you. Trying to time the market. Instead, invest consistently. Chasing trends or hot stocks. Instead, own the whole market. Paying high fees. Instead, choose ultra-low-cost index funds. Not having a plan. Instead, follow a written investment policy. Ignoring tax shelters. Instead, use 401(k)s, IRAs, and HSAs. Letting emotions control you. Instead, trust the process. Overcomplicating your portfolio. Instead, keep it simple and strong. The Boglehead approach is not about getting rich quickly. It's about building lasting wealth through discipline, simplicity, and time. Direct hit what's coming in part 4? In the final episode of this series, we'll explore the mindset of successful investors and how you can build the habits and psychology needed to stay wealthy for life. If you're serious about financial freedom, you do not want to miss it. White heavy check mark like this video if it helped clarify your strategy. White heavy check mark subscribe and turn on notifications for part 4. White heavy check mark share this with someone who's just starting their investing journey. Inbox tray comment below. Which of these mistakes have you seen or made? Let's help each other learn. Thanks for watching, and remember, you don't need to be perfect. You just need to avoid big mistakes and stay the course. See you in part 4.